Okay, so we we are going to look at how entities manage uh, financial risk. Okay, and if we talk about financial risk, we are going to be talking about risks arising from foreign exchange what transactions. Okay, so we have looked at uh those of us doing financial reporting. We have looked at what IS 21, where we say that the IS 21 deal with what issues where two companies are trading with their what with themselves on credit basis, but with different currencies. Okay, so let's come to this situation. There is going to be So let's say you have purchased an item, or let's say you have purchased a car, or let's say that you have purchased shoe. Okay, you have purchased shoe on credit. Okay, you have purchased shoe on credit for an amount of let's say 2,000 US dollar, and you have been given 30 days to pay. Okay, you have been given 30 days to pay. Let's say that at the day that you are buying this particular shoes, or at the day that you are buying this particular shoe, the exchange rate was $1 is equal to 13 cedis. That's the day. The date that you are buying this particular one, the spot rate. Okay. The rate or the exchange rate at the date that you are buying this shoe on credit is $1 to what? To 13 cedis. So the issue is if you should have cash to pay if you should have uh if you should have if you should have gotten cash to pay for this particular shoe at the date of the transaction, you should have been paying 13 cedis for $1 at that particular date. So the amount that you have to be paying in Ghana cedi, the amount that you have to be paying in Ghana cedi would have been USD of 2,000 multiplied by the 13 cedis. And you'll be paying something like
26.
26,000. Okay. But you don't have cash at that time to pay. So they have given you 30 days now. Let's assume that at the day that you are going to make the payments. Okay. Date of payments. So the date of payments, at the day that you are going to be making the payments, the exchange rate is now USD is equal to let's say 20 cedis. So let me use 20 cedis here. Okay. The day that you are going to make the payments, it is now what $1 is now equal to 20 cedis. How much are you going to be paying in excess per dollar at the day that you are going to be settling this particular transaction? How much are you going to be paying in excess per dollar at the date of the settlement?
That was 7 cedis.
So you'll be paying 7 cedis in excess. Okay. These 7 cedis, you are going to be paying 7 cedis in excess, or you are going to be paying the Ghana cedi equivalent that you are going to be paying at this date is 40,000. Instead of you paying 26,000, you are now paying 40,000. It means that you are going to be paying 14,000 in excess. Okay, this 14,000 is as a result of what? The exchange rate movements. So you are going to be making a loss. There will be an exchange rate loss of 14,000. This is as a result of what? The exchange rate movements. We don't know. We don't have control over the exchange rates. Okay, so it can also happen at the day that we are going to be making a payment, the exchange rate can even be 25 cedis. Okay, so since we cannot predict the exchange rate movements, okay, we cannot be there and be saying that, okay, let's wait at the date of the settlement and see what is going to happen. It can happen that the exchange rate will move against us, or the exchange rate will not be in a direction against us at the date of what? Of the settlement relating to that particular transaction. the exchange rate will now go in our favor. But we cannot be there and leave this particular exchange rate movements to anything that is going to happen. No, we cannot actually take that risk. You can see that we are paying 14,000 in excess. So the issue is, how do we manage? How do we manage, since we don't have control over the exchange rate movement? How do we manage? How do we manage to avoid the implications of what the exchange rate movement at the day that we are going to receive the money from the customers, or at the day that we are going to be making payment to what, to the suppliers? So we are just trying to be able to manage the exchange rate movements. Okay, we cannot be there and we say that, okay, let's just be there. Whatever happens, that is fine. The exchange rate can move in our favor, or can also move in a direction against us. So how do we manage? How do we manage this particular loss of 14,000? That's what we are going to be looking at. So we'll be looking at the movement in the exchange rate. How do we lock it up? Okay, how do we manage it? So this one, if you just leave it like that, you are going to be paying 14,000 SS. So how do we manage so that this particular loss can be reduced to something like 7,000? So instead of us uh, incurring a loss of 14,000, we are reducing it to 7,000. So how do we manage our financial risks? So we are going to be looking at the first issue. Another financial risk is to look at what we call the currency risk. Okay, the currency risk has to do with our exchange rate what movements, the exchange rate movement. So how do we manage our exchange rate movement? Since we are going to be carrying out some transactions, some foreign transactions on credit basis, how do we manage the adverse movement in the exchange rate against us? How do we also manage the favorable movement in the exchange rates in our favor? How do we manage that particular one? Okay, another issue under the financial risk management, that is this one. So we are going to be looking at the movements in the exchange rates, which we call the currency risk. Okay, then we are also going to be looking at another issue. Sometimes we can also, like, you can be you can be in Ghana here and you have a dollar account, or you would like to borrow. Okay, you like to borrow from a bank. If you want to borrow from a bank, you'll be borrowing in a foreign currency, and they are going to be charging you the interest in the foreign currency. So let's come here. Let's come here. Let's assume that this is January, or this is June 1, 2012. Okay, if you want to borrow in dollar, the borrowing rate, let's say the borrowing rate in dollar is, let's say, 6%. Okay, we'll be needing a certain amount of dollar in 2 months' time, and that will be in 2 months' time. That will be August. Okay, in 2 months' time, that will be August. This one. Okay, it can happen that this exchange rate, this interest rate will now be what? Will now be increasing, or will not be. So let's see. At the time that we'll be needing the money, the exchange rate is now 9%. The interest rate is now 9%. You can see that our interest rate has increased by 3%. So it means that we are going to be paying additional interest on the amount that we are going to be taking. We are going to pay additional percent of interest, which is 3% on the amount that we are taking. So we know the interest rates at the date that we are thinking of taking the loan in 2 months is 6%. This interest rate can move against us at the day that we are going to be taking the loan. So at the date of taking the loan now, they say the interest rate is now 9%. You can see that it has increased by 3%. It can also happen that this interest rate will be 12%. The interest rate can be 12%. It means that it has increased by 100%. So how do we manage these particular movements in the interest rates? How do we manage this particular movement in the interest rate, so that if you want to invest, you have made a decision to invest now, you'll be investing, the investment will start maybe sometime now. So how do we make sure that the interest rate that you're having today will not go against you in the future? You can also go and have an arrangement with the bank so that they can give you a particular interest rate, whether the interest rate is moving or is not moving. You just come and invest or borrow at that particular interest rate. So you will also be looking at the interest rates risk management. So we'll be looking at only two issues: interest rates management. So we'll be looking at currency rates management, the interest rates risk, which has to do with what? The interest rates for borrowing and also investment. These are the Uh, these are the two issues that we are going to be looking at. So the entity will be dealing with foreign customers that they are going to be selling to them, okay, on credit or buying from them on credit. There is going to be, since we are selling and we are not taking the money on the same day, there is going to be some movement in the exchange rate. The exchange rate might be what? Might be reducing or might be increasing. That will go up. That will go against us. But we don't know the actual interest rate or the actual exchange rate at the date of the settlement. So what we do is that let's now develop a policy, or let's now take action to reduce the movement of the exchange rate at the date that the transaction will be settled. So we just want to make sure that the exchange rate loss or the exchange rate gain that we are going to be suffering or we are going to be having from the transaction is being minimized. We cannot just leave the exchange rate like that. It can go they can go beyond what we are expecting. So how do we manage it? We are going to be looking at that. The interest rates also. How do we manage the movement in the interest rate so that we don't pay higher interest or we don't end a lower interest in the future if we have the intention to invest or whatever. Okay, that's what we are going to be looking at. But before that, we have to look at the types of what? The types of risks. Not just the types of risks, the types of what? Currency risk, the types of currency risks. So we're looking at types of currency risks, which they have asked the last time. That is, you explain for uh, that you explain for 33, that you explain for 33 marks. Okay. The first one is we have translation risks. Okay. The translation risk is basically covered by translation risks. So I have the translation risk. The translation risk is basically covered translation risk. Okay, is basically covered by IS 21. Okay, the translation risk comes in. The translation risk comes in because of investment in what? In a foreign operation. The translation risk comes in because of what? Investment in foreign operation. So a company will be in Ghana here and they have acquired a subsidiary in what? In Nigeria. So a company in Ghana here have acquired a subsidiary in Nigeria. What is going to happen is that the company in Ghana supposed to prepare a group what? A group account. So if you are preparing a group account, the group account must be prepared in the currency of the what? Of the parents. So we are going to be preparing a group account in the currency of the parent. Okay. The parent is going to be consolidating the subsidiary, but the subsidiary financial statement is in what? Is in Naira. And the parent own, who is located in Ghana, is in what? Is in Ghana cedis. So it means that we have to change the Naira of the subsidiary to Ghana cedis now so that we can consolidate the two. Okay, so what will happen is that we are going to be translating their items now. So their profit or loss items will be translated using average rates. This is always done in corporate reports in foreign subsidiaries. Okay, so we translate their profit or loss items using the average rate, which is the average exchange rate. Then we translate their balance sheet items using the closing rate. That is the rate at the reporting date. Okay. There is going to be some form of what? There is going to be some form of gain as a result of that translation. Okay, so the losses or the gain that you are going to be incurring as a result of translating the financial statement of the foreign subsidiary to that of the parent, any gain or loss that you are going to be having over there, that is what we call what? The translation risk. So you are incurring any loss or a gain over there as a result of you translating the financial statement of the subsidiary to that of the parent. So this is what we call the translation risk. The translation risk is basically about what? Translating the translating the financial statement or any risk that is being suffered by an entity as a result of what? Translating the financial statements of a foreign operation or a foreign subsidiary to that of what? The currency of the parents. So the risks that you are going to be suffering over there, the loss that you are going to be suffering over there. We say that particular loss is as a result of what? Translation risk. Okay. The next one is what we call the transaction risk. Okay. The transaction risk. The transaction risk is the main risk, is the main focus of this particular one. So whatever risks that we are going to be looking at, whatever gain that we are having as a result of we carrying out or we using a particular hedging technique, we using a particular method to now what? To now reduce our exchange rate risk is we are going to be using the transaction risk. The transaction risk is as a result of what I've done over here. Okay, transaction risk. The transaction risk is going to be a transaction happening between two entities or two individuals. But this particular transaction is going to happen on credit what? Credit basis. So the transaction risk is as a result of the risk suffered. The risk suffered as a result of what? Trading among entities, trading among entities on credit basis, on credit basis, but the payment is going to be done at what? At a later date. So a situation where there is a transaction happening between entities, sales have been made or purchases have been made to a particular entity on credit, or sales have been made today or purchases have been made today, but the payment have been deferred into a future date. Okay, so the exchange rate movement over there, whether gain or loss, is what we are going to be calling the transaction rate. So the transaction rate is as a result of what? A transaction happening between two entities, and the payment will be what? The payment will be settled at a particular what date. Transaction happening today, but the payment is not going to be done today. The payment is going to be what? Settled at a later date. So if you are settling the payment at a later date, the exchange rate, if you have money today, will be different from the exchange rate at the day that you are going to be making a payment. So any difference over there as a result of the movement in the exchange rate, that's what we call the what? The transaction risk. Or the transaction rate is the basic rate. When you buy something from US, you don't have money to pay now, and you are paying later. And there's now exchange rate what losses against you. You are now paying more. That particular rate over there is called you are suffering that particular losses as a result of what we call the transaction risk. The transaction happened that day, but the settlement is going to be what? Is going to be done at a at a particular date or at a later date, and there's going to be exchange rate movement over there. So that losses that you're going to be suffering, that risk over there, that the risk that you'll be exposed to, the risk can be the increase in the exchange rate or decrease in what? In the exchange rate. That possibility of you losing or gaining over there is what they call what? The transaction risk. So the transaction risk is what I've demonstrated first over here. As a transaction between two entities. However, the settlement has been deferred to a later date, and there's going to be a risk of you paying more or a risk of you paying less. That particular risk is what we call the transaction risk. We call something economic what? Risk. Economic risk is a risk or losses that you are going to be suffering or something that you are going to be suffering from as a result of what? Improvement in as a result of improvements in the economic factors of a particular country against the other one. So let's come here. Let's assume that we have two. So I'll be looking at economic risks. So economic risks, there is going to be improvements in the exchange rate of one particular country, but that particular improvement is as a result of what? Economic situations of the country. So let's come here. Let's assume that we have two dealers over here. So we have two dealers over here. So we have dealer A and dealer B. They are all in what? They are all selling cars. Okay, so let's say we have the dealer A is Katanka. Okay, and the dealer B. So Katanka is producing Ghanaian what? He's producing domestically, but the B is buying or importing them. It's importing the cars. Okay, so let's come here. Let's come here. So let's say that the Katanka normally buys what? The raw materials. Katanka normally buys what? Raw materials. Katanka normally buys the raw materials in the what? In the local currency. So Katanka normally buys the raw materials in the local currency. Okay. So Katanka is buying this particular one in the what? In the local currency. So he is buying the raw material in the local currency. Okay. The Katanka is buying the raw material in the what? In the local currency. And this person just buys the what? Purchases the cars in what? In its original state. So we just purchase the car and sell. But this one we are what? Importing the cars. But this person is what? Is producing the cars himself. This person is producing the cars himself. So we are buying these cars from US, straightforward. And the cars that we are purchasing over here, the cars that we are purchasing over here, the cars that we are purchasing over here is going to be, let's see, USD is equal to, so what we are buying over here is uh the exchange rate over here is USD is equal to USD is equal to USD is equal to 12 cedis. USD is equal to what? 12 cedis. Okay. But Katanka is buying this raw material. Let's see the raw material that they are going to be buying. So let's see uh the raw material that they are buying. Let's say one unit is, let's say, 15 cedis. Okay. So we can say that the raw material the car that we are buying, the exchange rate is what? USD. One USD is equal to 12 cedis. Okay. But the Katanka is paying 15 cedis per raw material. Let's say 15 cedis per raw material now. 15 cedis per raw material. Okay, they are paying 15 cedis per raw material. Okay. Among these two people, which of them is going to suffer in terms of what selling their cars?
I think that would be A.
Okay. Who is going to suffer? Who is going to suffer? Let's say they are okay. Let me just put it. They are all buying the raw materials. Okay. But one of them is buying what? One of them is buying domestically, one of them is buying from outside. So the raw material that we are buying at what? $1. Okay, we are buying raw material $1 is 12 cedis. But these people they are buying one raw material at 15 cedis. Okay, among the two people, who is going to suffer in selling the what?
A.
A is going to suffer, isn't it?
Yeah.
Okay, because the selling price of the cars of A is going to be what? Is going to be higher than that of the B, isn't it?
Yeah.
Okay. What is the reason? It's because of the raw material price, isn't it? Okay.
Yeah.
You can see that it is very cheaper to buy from US than to buy from Ghana. Okay. So why? You can see that the raw materials in US, they are very cheaper as compared to what? As compared to Ghana over here. So if you try to look at it, one of them is going to be having one of them is going to be buying the raw materials at a cheaper price as compared to the other one. Why? Because the economic what situation in the US is better than the economic situation in Ghana. So this particular the risk of this person paying 3 cedis in there for the raw materials as a result of the economic situations in Ghana. It's as a result of economic situations in Ghana. It's as a result of what? Economic what? Situations in Ghana. It's as a result of economic situations in Ghana. So they are suffering this particular one over here because of what we call economic risks. So the economic factors in terms of inflation and other issues in the US is better than in Ghana here. So that's why someone who is buying from US is paying cheaper than person who is buying from Ghana. Okay, let's come to another situation over here. Let's come to let's say that one of these people they are buying and they are selling what? they are buying and selling what selling outside. Or let's say that one one company is in the US and one company is in what is in Ghana here. So one of them will be buying the raw materials in the US and one of them will be buying the raw materials in Ghana cities over here. So let's come here. Let's come here. So although this particular example will still be relevant, but I want to look at is where these two companies are operating in different what in different economy. They are operating in different what economy. They are operating in different economy. They are operating in different economy. So let's come here. Okay, let's come to this particular situation here. So let me see. They are operating a different economy and they are selling to the same market. So let's come to a situation here, situation here. I'm trying to figure out a different example. So we have the A over here and the B over here. So let's see. A is in Nigeria. A is in Nigeria and they are A is in Nigeria. So we assume that what I'm going to do over here, let's assume that A is in Nigeria and they are buying raw material and the USD over there is equal to, let's see, 2,000 Naira. Okay. So let's come to this company is in Ghana here and USD is equal to, let's see, all things equal, that is equal to, let's say 2 cedis. Okay, let's say 2 cedis. Let's say 2 cedis. So let's assume that these two companies are going to be selling. Let's say they are selling domestically, and they are going to. So let's say they are selling domestically, or you want to operate. Let's say you are a car dealer now. Okay, in this all things being equal, among these two countries, okay, where will you want to operate? All things being equal, among these two countries,
Country B.
uh, we have that these are the A and then the B are dealers. So let me give you the exchange rate of Ghana cedi to the Naira so that you can be able to make your this thing. Let's say one Ghana cedi is equal to 500 was Naira. Okay, if you are car dealer, okay, if you are car dealer, where are you going to be operating? Where would you like to operate?
Okay. Then based on this, I would say the A.
No, we have Ghana and Nigeria. So
I would say Nigeria.
are you sure?
Hmm.
Like you would
I
like to
think
operate in
Ghana,
you operate in what?
because Ghana, because even if you compare the USD, two Ghana cedis is equal to just $1,000, 1,000 naira, and then it is better, far better than paying 2,000 naira for $1. So I put in Ghana.
Okay. So you'll be operating in Ghana. You are going to be operating in Ghana because the exchange rate of the Ghana city against the what? Against the dollar is what? Is better than that of Nigeria. Why a company in Nigeria will be suffering? A company in Nigeria will be suffering if we have the same company in Nigeria will be suffering in the what? In the international market as compared to a company that is in Ghana because the economic situations in Nigeria it is not what is not good as compared to the Ghana. That is why the exchange rate of the dollar to Ghana city is better than the exchange rate of the dollar to the Naira. Okay, so if a situation like this is happening, a company operating in Nigeria will be what? Will be affected on the global market because if we are all selling in what? In dollar, we are going to be suffering because we are going to be incurring more cost to produce the what? The cars than someone who is in Ghana who is going to be incurring what? A less cost. Okay, so the company in Nigeria will be suffering. Why are you suffering? You are suffering in the global market because of what? The different economic situations in these two countries. So what you are going to be suffering, the suffering that you are going to be suffering that the global market is as a result of what we call the economic risks. So different economic situations in the what? In the two countries that have been reflected in their what? In their currency. That's what we call the economic risk. Okay, this is a typical example of the economic risk. So the economic risk, we can read that particular portion of it, and that so we have the three types of what currency risk. We have the translation, which is always covered by IS 21, effect of foreign exchange transactions or foreign exchange rate transactions. Then we have the transaction risk as a result of you selling to somebody on credit and the person paying later, there will be an exchange rate movement over there. That is going to be called a transaction risk. You are now enjoying some kind of what? You are enjoying some kind of what? Some kind of a gain or liberty in the global market as a result of economic situations in your country being better than what? Economic situations in your competitors what? Uh, country. So you are now, your items are now cheaper as compared to them is because of the economic situation. So that particular gain or losses that your competitor or your counterpart are going to be suffering is as a result of what we call the economic risk. Okay, they can give you a question to forecast. So how do we forecast? Sometimes we don't know the exchange rate movements. Okay, we don't know the exchange rate at the time the transaction happened. The exchange rate can be something like $1 is equal to 12 cities. Okay. But we can now we can now determine something over here. We can now determine something over here. If we are saying that the exchange rate in the two countries moves in the what? Moves or is changed by, if we consider the exchange rate in the two countries is actually influenced by the inflation level in the countries. Okay. So if we are saying that, okay, US so this is a sports rate. This is the rate as of today. We are saying that we are expecting inflation in US to be what? To be 5%. What it means is that we are expecting the price of items in US to increase by 5%. Okay. But in Ghana, we are expecting price of items to increase by 10%. Okay. We can use the inflation rate now to now estimate. So these are the yearly what? Yearly increase. So we are saying that the increase in prices is mainly what? Mainly influenced by inflation. So okay, if prices of what? Uh if prices in the US are going to be increasing by 5%, in Ghana they are going to be increasing by what? By 10%. In the two countries, what is likely to be their new prices in a year time? Okay, what is likely to be their new prices in a year time? We are going to be doing that. So how will be what will be the exchange rate in a year time? But let me give you something. Sometimes they can quote exchange rate like this for you. This particular exchange rate is what? USD is to Ghana cedis. So this is like the USD, one USD is to what? Is to Ghana cedi. Sometimes this can also be quoted as USD like this. Okay, USD like this, and they'll give you something like 5.6. Okay, this is just like one USD to Ghana cedis. One USD. This is one USD. This is USD to Ghana cedis is 5.6. Which means that one USD is equivalent to what? 5.6 what Ghana cedis. So they can quote something like this. They can give something like this. This is also is true. Okay, this is true. They can give you something also like this, which is USD per Ghana city. They can give you something like this. So if you are giving USD USD per Ghana cedis. So they can say 1 USD per Ghana cedis, or let me just say USD per Ghana cedi. USD per Ghana cedi is USD per Ghana cedi. So they can give you some figure like okay, they can give you some figure like USD per Ghana cedi is 6.1. Okay, USD per Ghana cedis. So they can give you USD per Ghana cedi. What it means is that 6.1 USD is equal to what? 1 Ghana cedi. That is the meaning. Okay, so USD per 1 Ghana cedi is different from what we are having right here. This is USD is 2, which is the same as what? This figure. Okay. Or let me just write this like this. They can give you Ghana cedis, per USD. And we know that the per over here is 1. So the Ghana cedi for 1 USD, so they can give you something like 5.6. So it means that 5.6 Ghana cedis is equal to 1 USD. That is the meaning. USD per what? So this is just like USD per. So this is just like the per is always what? This is just like cost. Let me just say 2 cedis per unit. Okay, 2 cedis per unit. What it means that 1 unit is what? Is 2 cedis. 1 unit is 2 cedis. So the currency will always be at the top. 1 unit is equal to what? 2 cedis. So this is the same as what? 2 over what? 2 over 1, 2 over 1. So 2 cedis. So this is the 1. So whenever they see per, it means that this particular one is what? Is 1. And this 5.6 is the Ghana cedis. So that is it. 2 cedis per unit. So 1 unit is 2 cedis. So $1 is 5.6. But if you are giving something like this, USD, this is interpreted. This is inter uh, this should be interpreted as what? USD is to 1 Ghana cedi. Okay, USD is to what? USD is to Ghana cedi, which is the same as this one. Okay, so you have to pay attention to how they do the quotation for you. Okay, the quotation, before we get there, let me just talk about quotation. Okay, the exchange rate can be directly quoted and can also be indirectly quoted. So they have asked this question before. So let me just explain what we mean by direct quotation and what the indirect what quotation. So I'll be giving you two, and I'll tell you which one is the direct quotation. So we can do USD is equal to USD is equal to 12 cedis. This is equal to direct quotation. Okay, direct quotation. What do we mean by direct quotation? Direct quotation is a situation where the 1 unit of the foreign currency are being quoted in units of the home currency, or the home currency are quoted in units for the foreign currency. So what it means is that a unit of the foreign currency, which is this one, that we assume that the company is in Ghana, so our currency is what is the Ghana cedi. So we say direct quotation is where the foreign currency, okay, the foreign currency is quoted in units of the what? Of the home currency or the base currency. What do you mean by the what? The home currency or the base currency? This is what we call the what? The home currency. So you can see that these are 1 unit of USD is 12 units of what? So for you to get 1 unit of USD, you need to bring 12 units of the Ghana cedis. So the foreign currency is now quoted in units. Foreign currency is now quoted in units of the what? Of the local currency. Foreign currency is now quoted in units of the local currency. What do we call the indirect quotation? Indirect quotation is the opposite of this. So you can say that we are now saying that the USD is now 0.009 is equal to 1 cedi. This is what we call indirect quotation. The indirect quotation is that the home currency, a unit of the home currency, are quoted in units of the foreign currency. Okay, 1 unit of the home currency will be what? Will be bought with a unit of the what? Of the foreign currency. So where the home currency, a unit of the home currency is quoted in units of the what? Of the foreign currency. We say this is indirect quotation. But if you have 1 USD is equal to 12 cedis, this is direct quotation. The 1 unit of the foreign currency are quoted in what? In the unit of the home currency. So this is a direct quotation. And this is the direct quotation that you always be having. But there can be a situation where we want to find how many units of the foreign currency will be used to purchase what? 1 unit of the what? Of the home currency. If you try to do something like this, this is indirect what? Indirect quotation. So they have asked this one and they ask the student to determine whether the quotation is direct quotation or indirect quotation. So this is what we call direct and indirect. Indirect is where a unit of the home currency are quoted in units. A unit are quoted in units of the foreign currency. Direct quotations, a unit of the foreign currency are quoted in units of what? Of the foreign of the home currency, which is the 1 cedi, $1 to 12 cedis over here. This is direct quotation. This is direct what? Quotation. We are coming to look at how do we forecast? How do we forecast the exchange rate? How do we forecast the exchange rate? Okay, I was using a particular example first. So I was saying that the spot rate for this particular transaction was 12 cedi. The spot rate was 12 cedi. We are saying that the inflation, so we are saying that the what increases the price of the two countries, what increases the price of what items in the two countries is just the what is just the inflation rate. So we are going to be having 10% right now. Okay, so let's come to these two situations here. So we are saying that this is per annum, this inflation rate per annum. All things being equal, what would be the price of what item? What would be a price of item if we're having 1 cedi now? A price of item in US now is 1 cedi. What would be the price of item at the end of 1 year in US if the price is increasing by 5%? What would be the price of item in US in a year time?
1.05.
1 point. Okay, so we have 1.05. Okay, Ghana city will be what? 13.1. 13.2. Okay, so let's come here. We are looking for a rate. What rate are we looking for? We are looking now for, okay, we are now looking for dollar to what? Dollar to Ghana cedis. Okay, and we know that dollar to Ghana cedis, the rate will now be quoted as what? 1 USD is to a particular value of the Ghana cedi. So let's come here. Let's come here. We can say now that's what the USD is to the Ghana cedis now. Okay, and the spot rate is 13 cedis. Can we say that is 13 cedis? Can we say that is 13 cedis? The spot rate is 12 cedis rather, 12 cedis. The spot rate is 12 cedis. Okay, can we say that is 12 cedis? Okay, how do we determine this? That is 12 over 1. Okay, so we are coming to look at the rate over here also. So I'll be doing the USD. The USD is to the Ghana cedis over here. This is what I'll do. Look at this one. I'll have 13.2 divided by 1.05. What are you having?
12.57.
0. Points.
12.
Okay, so we have this one. We now have 12.57. So it means that our exchange rate in a year time, based on the spot rate, is going to be what? It's going to be 12.57. We are just saying that this is going to be what? This is going to be increasing by. So we are saying that the movement in the exchange rate is basically about the inflation in the two countries. So we are expecting prices of what items in Ghana to increase by 10%, while we are also expecting what prices of items in US to be increasing by what? To be increasing by the 5%. Let me also write something here. Look at it. Can we say that our exchange rate, which is USD to Ghana cedi, can be calculated as, let's come here, 12 multiplied by 1.1 divided by 1 multiplied by what? 1 multiplied by 1.05. Do you agree? Okay. Can we also say that this is the same as 12 over 1, or 12 over 1 multiplied by 1.1 divided by 1.05? Okay. Can we also say that this can also be written? Okay, this can be broken down like this. Okay, let's come here. This can be broken down like this. This can be broken down like this figure. 12 over 1, 12 over 1 multiplied by 1 plus 0.1 exponent 1 divided by 1 plus 0.05 exponent 1. We can also say something like that, isn't it? Okay. What it means is that this one the exponent 1 is that we are doing it for only 1 year. So if you are doing it for 2 years, it means that you have to find a price in 2 years' time for each of the two countries. Okay. Then let's come here. So if we are still under the forecasting of what? We are still under the forecasting of this particular one. What is this figure? Can we say this is the spot rate?
Yes.
Okay. Can we say this is the inflation? The 0.1 is inflation in the base currency.
That's
Okay.
it.
And this is inflation in the what? In the other currency or the foreign currency. Okay, let's come here. Okay. So we are looking at forecasting what our uh forward rates. Okay, we are forecasting our forward rates or our exchange rates. And this is mostly done from two perspectives. We assume that whatever is increasing the price of the items is purposely for what? Inflation. So we call one of them is under purchasing power. So we'll be having purchasing power parity. So purchasing power parity, we use the purchasing power parity to determine this one. This is based on the inflation in the two countries. Okay. So our forward rate, which is be the rate in the future, is always calculated as what? The X1 is equal to the spot rate. This is the spot rate. Okay. The spot rate over here multiplied by 1 plus 1 plus. Let me go and pick that one over there for you. I don't want you. Okay. So let me pick that particular rate for you now. What is it? What is the formula there? So I'll be looking at the purchasing power parity. Okay. So we have the HC. Okay. The HC. So we have the HC at the top. Okay. The HC 1 plus HC. Let me take this one from here so that everything will be okay. So I have the rate in a year time or in 6 month time. They can give you any data at all. So we have the spot rate multiplied by 1 plus the HC divided by 1 plus divided by 1 plus what? The HB. Okay. And what is the meaning of the HC and then the HB? Let's come here. You can see that the HC over here is the 0.1. That is the inflation in the what? In the home what? In the home currency. Okay. The inflation in the home currency. Okay. The inflation in the home currency. So let me just put these items for you there. So let's come here. Our our HC is the inflation in the home currency, which we call the counter currency. Okay, which we call the counter currency. So is the inflation in the other currency, that is the Ghana cedis. Let's come here. The HB over here, inflation rate in country for which the spot is quoted. Let's come here. We are having this particular figure as 12 cedis. So the spot is quoted in the what? In the USD. We are quoting this in USD, not Ghana cedis. We are quoting this in what? In the USD. So the HB, let me just put it like that. The HB is always the currency with a one. The HB is always the currency with a one, which we call the base currency. So if you're having something like this, USD is equal to, let's see, euros, let's say 12. The HB is the inflation in the country which is having the what? The one in the quotation. So the inflation of the country which is having the one in the quotation. The inflation of the country in the so many units is what we call the what? The HC. So this is the HC, which we call the counter currency or the other what? The currency of the other country. So they'll give you information on this one. So this the HB, inflation in the country for which the spot is quoted. The spot is always quoted in the country having the one. The country having the one, the currency having the one. Okay. And the AC is the currency having the many units. So it can be 12, it can be 0.00. That is also in so many units. The HB will always be the currency having the one. Okay, the inflation in the what? In the economy, which is having its currency to be the one. So in the quotation, the one having the one. Okay. So this particular formula will be given to you in the exam. Okay. Let me come to this particular issue also and explain this for you. Okay. They can ask you to determine the sports rate in 6 months' time. They can ask you to determine the sports rate in 6 months' time. If we are still using the same example, if we are still using the same example, and they are asking us to determine the sports rate in 6 months' time, this is what will happen. In 6 months' time, our inflation for US will be 2.5%, and the inflation in Ghana will be 5%. Do you agree? In 6 months' time, the inflation in US, every rate that will be given to you is assumed to be an annual rate. So if using the same information, the inflation in US will be what? Will be 2.5% in 6 months' time, and in Ghana will be what? Will be 5%. So let's now calculate our spot rate. So what will be the inflation in 2 months' time? What will be the price of items in US in 2 months' time? That will now be 1.025. Okay. Ghana will now be what? What will be the inflation in Ghana now? Would that be 12.6?
Yeah, 12.6.
Okay. So our USD is to Ghana cedi now will be 12.06 divided by what? 1.025. What are you having?
It's 12.6, not 12.06.
Okay, sorry. Okay. So what are we having?
Um, 12.2.
2.9.
Okay, 12.29. So let me also determine this one. Can we say that 12.29 is determined like this? 12.29 is 12 over 1 multiplied by 1 plus 0.1 divided by 2. Okay. and 1 plus what? 0.05 divided by 2. Do you agree?
Yes.
Okay, so you can also calculate this one using the formula. So everything that we are calculating over here is just derived from the formula. So that's why I've done this now to write the formula down for you. The same thing, but just I will use the formula. Okay, so if we are saying that the only thing that is influencing the what? The increase in the prices in the two economy is what? Is the inflation. So we use purchasing power parity to determine the what? The rates and the settlement date. So we use the inflation. We increase the prices of the items using the same thing. The same way we can also say that what is increasing the price is the interest rate, the rate at which we are borrowing, or we are what lending money to people. So that is the one that is increasing the what? The exchange rate. So the exchange rate of Ghana is going to be increased by the interest rate given by the Bank of Ghana or whatever. So we also use the interest rate, which is what we call the interest rate parity. The interest rate parity. So we call the interest rate parity. The interest rate parity. The interest rate parity also is just like this one. We are just going to be increasing the rate by the interest rate and not divide. So the same thing over here, but just that instead of us having the IC over here, mostly we have, instead of us having HC over here, we have IC and IB. So that will now indicate what? The H is now the inflation. But if we change it to I, the I now is the interest rate. It is going to follow the same thing. It is going to follow the same thing. Okay. So the IC is now the interest rate in the other currency, and the IB now is the interest rate in the what? In the currency in which the what? The spot is what is quoted. Let's take two examples and estimate that, and now look at the issues of maybe the hedging techniques now. How do we hedge our issues? We look at some of them now, and we okay, we cannot finish everything now, but we try our best to do at least maybe half of it, and we will do something to okay, let me just use this one. Okay, let's try the two. Someone should read the two for us now. Question number.
Redco is based Redco is based in country H, where the functional currency is the H dollar or HS. The spot rate for the HS to the euro is 5.5 HS1. The expected rate in the eurozone and country H respectively are 2.5% and 6.5% over the next required. Calculate the forecast forward rate of exchange in 1 year's time using the interest rate priority period. Assuming Redco has an outstanding balance of euro 300,000, which is due in 2 years, time from one of its customers is due. Calculate in 2 years' time the amount Redco will receive in dollars.
Okay, so this one they are asking us to determine. They are asking us to determine the. They are asking us to determine the 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 forecast forward rate. So the forecast forward rate is just the rate at the date of what? A rate at a particular date. So this one they're asking us to do it. What will be the rate based on if the rates the rate in the two countries, the uh, figures in the two countries are being influenced or are being increased by the interest rates. Then what would be the what? What would be the rate based on the interest rate in a year time? So they're asking us to do a year time. So this is going to be based on the the interest rate parity. So we'll be looking at the interest rate parity, and that is question number two. So you have question number two that is going to be on the rate. So we'll be looking at the forward rate. The forward rate is always the X1. Okay, this is if you are doing it for a year. Okay, X1. Okay, so it's equal to the spot rate multiplied by the 1 plus the IC, okay, divided by 1 plus what? The IB, okay. So let's come here. We have the X1. What is the H? What is the spot rate over there? It's 5 point what?
5.55.
Okay. Multiply by 1 plus, okay. What is the what? What is the currency? What is the exchange rate of the currency with the numerous figures? The currency that are in units. The currency that are in units. What is the figure for that one now? Okay.
2.5%.
Is which one?
2.5.
That is 2.5. Okay. So we will have it 0.025. Okay. 0.025. And this will be 1 plus 0.065. Okay. This one they ask you for only 1 year. If they ask you for 2 years, you exponent your answer by 2 because it means that the 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 currency is going to increase by 2 years because the first one you are looking for the rate in 2 years time, so it will be the first increase. That will be 5.550 multiplied by 1.025 multiplied by 1.025 because we are looking at the exchange rate in what? In 2 years time. So that will be, it will increase. The rate will increase by 2. It will increase 2 times. So you do it for this one. So what you do is you just exponent 2. You just exponent your answer by what? By 2. But this one they're asking us for 1 year. So let's come here and do our final answer here. So what are we having? 5.550. Okay, 5.550. So just do the brackets and give us one answer for that so that we can multiply.
0.962.
0.962. Okay, so if you multiply, what are we having?
5.34.
5.34.
34.
Okay, 5.34. Okay, what it means is that in a year time, the euros are going to be stretching against what? Against the what? Against the dollar. This is the meaning. Okay. So this is the spot rate. As a spot rate, this is the rate at the end of the first year. So they are now asking you a different question. They say that if the person is going to be receiving a certain amount of money, if the company is going to be receiving a certain amount of money in 2 years' time, assuming Redco has an outstanding balance of 300,000 euros, which is due in 2 years' time for one of its customers in Europe. Calculate in 2 years' time the amount Redco will receive in what? Receive in dollars. So we are going to receive the euros, but we are not dealing in euros. So we receive the euros and now convert it to what? Convert it to our currency. So if you are selling to somebody in US, the person will pay you in dollar. You will not receive the dollar and change it to Ghana cedis because you are dealing in Ghana cedis. Okay, let's come here. We have to ask ourselves in 2 years' time, what will be the exchange rate? Do we know the exchange rate? Do we know the exchange rate at the day that the entity is going to receive this amount? So on the question that we have, do we know the exchange rate? That will be there. The rate at which we are going to be exchanging this amount in 2 years' time. Do we know that?
No.
We don't know, but we can determine that, isn't it? Okay. So we can actually determine that. How do we determine that? Very simple situation. We know the spot rates, and they are saying that these rates are going to be increasing by 2.5% and 6.5% every year. So just increase the rates 2 years and just divide. You get your rate at the end of the 2 years. So I will do this one in 2 ways. So I'll have my X2, which is the forward rate in 2 years' time, which is the rate at the end of the second year. Then I'll have my spot rate over here multiplied by, I'll have 1.025 divided by 1.065 or exponent 2. Okay, or let me just do it like this. Don't do all exponent 2. Let me do the exponent 2 over here for you so that you will not have problem. Okay, so you'll be having your x2 is equal to this figure 5.550 multiplied by. Let's do that one for us. What are you getting? Final answer for that.
0.936.
0.926.
36.
So if you multiply, what are you having?
5.139.
5 points,
139.
5
So
points,
5.14.
5.14. Okay, I will show you different one again. You can also build up. You can build up. You know that at the end of the first year, what is it? The exchange rate will be what? 5.340. So it means that this will not increase by additional 1 year. So you can start with the year 2, the year 1 exchange rate. So it means that this is the end of the year 1. So if you want to know year 2, you increase this one by 1 year. So I can have year 2 now to be x1 multiplied by the figure over here, which will be 1 plus 0.025 divided by 1 plus 0.065. So I'll just do this one because I'm going to be using the year 1 exchange rate. So if I'm using year 1 exchange rate, for me to get year 2, it means that I'll just have to increase by 1 year. Because I've increased by 1 year, that's why I've gotten the year 1 figure. This is the rate at the end of year 1. So I have 1.025 divided by 1.065. So I'll be having year 2 to be the euro, okay, 5.340 multiplied by 0.926. Okay, what are you having?
So it will be multiplied by 0.962.
Oh no, sorry. This will give us what?
962.
0.9.
962.
Okay, so what are you having as a final answer? 960.
5.44.
Okay. Please, what I'm using over here is only applicable if the rate of the interest is the same. Okay, they can give different rates for each year. So it means that you have to do it separately for each year. Okay, so this one, if the rate is the same, what means that every year it will be increasing by 12, 2.5, 6.5. So this one we can just do it because the next year own, the first year own will be increasing by 2.5 to 6.5. But if the rates are given to you differently, let's say they can say that the first year, the first year rate will be 2.5, and this is going to be 6.5. Okay, then what they'll do is that they'll say second year will be 3%, and this will be this one. So it means that you have to change this one to 3% and this figure. Or they can give you some of them for 3 months, and they'll give you some of them for 6 months. You do them separately. You do them separately because the rates for 3 months might not be the same as the rates for 6 months. So you now tackle them separately. I'm sure I have a question there. Let's count to the amount that we are going to be receiving. Let's count to the amount that we are going to be receiving at the end of that particular month. The amount outstanding. So we need to identify the amount was outstanding. That is going to give us an euro of 300,000. Okay. We know that our exchange rate is now the H dollar. So our exchange rate is $8. You have to determine whether you are going to be dividing to get the other currency or you are going to be multiplying. Very important. That is going to be 1 is equal to the euro, which is 5.14. This is the exchange rate and the date of the transaction. Okay, let's come here. If $1 is equal to this figure, then how many dollar will be equal to the what? The euro 300,000. Please, are we going to be dividing or multiplying? We are going to be dividing. So you will now have okay. So we will now have the receivables when you receive that money. Okay, when we receive that money, it will now be our figure will now be the euro 300,000 divided by the euro 5.14. So what will be our dollar equivalent of that amount?
5,836.76.
5.
8,365.
Consider, can you increase it by 5 words?
5,836.76.
Okay. So this is the amount that we are. If we receive the 300,000,
5,836.5.
5, 6.
8.
Okay. So if we receive the 300,000 and we convert it, so this is the dollar equivalent that we are getting for that amount. Okay. Let's pick another question on the forecasting. Then I will talk about the hedging techniques. So they can also ask you about some theoretical questions on the hedging techniques. Okay. Let me check if I have a different one there. Let me check if I have some different one there for you. So I can talk about the hedging techniques now. And we can okay, so now take the 10 for us.
Value Power Ghana Limited is into the manufacturing and sale of drugs in Ghana. The company imports its raw materials from abroad from credit. The suppliers grant them between 3 months and 6 months credit due to their good track record in payment. The company currently has the following invoices due in. So 3 months time is USD 2 million. Then 6 months time is USD 1 million. They are looking to buy USD per Ghana city forward to hedge their exchange rate risks, and their bank offers them the following rate. So 3 months is 5.65, and then 6 months is 5.98. The interest rates applicable to their company for both CD and US dollar for the same tenor is as follows. So 3 months, 15. For Ghana cedi, 50%. For USD is 2%. 6 months. For Ghana and for USD is 3%. Ghana cedi is 5.3. Required as a newly appointed Finance and Treasury Director of the company, calculates the forward rates for the various tenors based on the information provided above.
Okay. So this one, they are telling you that estimate, you should estimate the forward rate. The forward rate is just what? The rate for each of the tenor. So we are having 3 months first, and we are going to be having what? Having the 6 months. So these are going to be increasing at different rates. The 3 months will be increasing at 15% rate in Ghana and 2%. Okay. The 6 months is going to be what? 20% and what? 3% for USD. So we cannot use the first approach. You have to do it separately for them. So if you come to the 3 month period, okay, the interest rate is going to be for 15%. So what about if you are doing this for 3 months? What will happen? It means that you now have to divide by 12 now and multiply by 3. That is going to give you. But if you come to 6 months, the rate at which the interest is going to be increasing every month is different from the 3 months. So we cannot do the one that we have done, that we have used the first year and do the top up for the second year. We do that when the interest rate or the inflation is going to be increasing at a particular rate. Although they have given you the forward rate already. They have given you the rates that the bank has given them. So the bank is saying that at the end of the 3 months, bring the money at what? We will give you $1 to what? 5.65, and we give you $1 to what? 5.98 cedis. Okay. in 6 months time. But they are asking you to calculate this one based on information. So they are telling you that you should estimate, the forward rate for them using the information above. Okay, so after estimating, they can ask you whether they should take the rate offered by the bank or something like that. But this one, they have not given you any issue like that. So they can also ask you whether they should hedge using foreign rates with the bank, or they should take their distance based on the arrangement there. We are still going to be using the interest rate parity. So I'll have question number 10 over here. So I have question number 10. So that is going to be the value of, okay. So I have the for rate for 3 months. So we have 3 month tenor. Okay, so I have 3 months. 3 months tenor. Okay. The 3 months tenor we are going to be having. So I have this one and just do it 3 months. Okay. So this we have 3 months. We have the sports rate multiplied by the 1 plus the 1 plus the IC, okay, 1 plus the IB. Okay, so let's come here. Our 3 months will be this figure. So we have the sports rate given to us to be 5.4. $1 is what? 5.4 Ghana cedis. Let's come here. Please, any rate that is given to you, any rate, interest rates or whatever, it is always given as an annualized what? Interest rates. Okay, so let's come here. We have this figure multiplied by 1 plus the IC now is the what? Is the interest rates in the home currency, or the interest rate for the currency that is quoted in units. So the currency that is quoted in units now is the Ghana cedi. So we have, I'll do this one. Please pay attention here. I'll have 0.15 exponents divided by 4. 0.15 divided by 4. Because we are doing this for just 3 months and they have given us an annual rate of what? 15%. So we divide by 4. Okay. So we do it on quarterly basis now. We find the interest rate on quarterly basis. So that would be this figure. So I'll now do 1 plus 0.02 divided by 4. That also gives us the quarterly basis. So I have the 3 months. That will give me 5.4 multiplied by what?
1.033.
1.032. What are we having?
5.57.
5.57. So this is the exchange rate. This will be the exchange rate in 3 months' time based on the information that we have. So we count to the 6 months what? We now count to the 6 month tenor. So the 6 months is going to be different because the increase in the interest rate every year is going to be different. So I have this figure. Then I'll now have the 5.4 again. I'll use the spot rate because the rate at which the interest will be increasing for 3 months is different from the rate at which it will increase for what? For the 6 months. But if they should give you 15 and 2%, that means that you can just do that from this particular figure because it will increase by additional 3 months. Okay. But this one, they are saying that the 6 months is 20 and what 3%. It means that the rate at which the interest will be increasing monthly is different from the first one. So you have to do this one separately. So you have this figure. I'll have 1 plus 0.20 divided by 4, divided by 2 rather, not 4. Thank you. So sorry. So we have, so 6 months, that will be semi-annually. So we just find 6 months rate. So if 20% is a year, then 10% will be for this particular one. So you just do, or you can just write 0.1 over there by changing the 20% to semi-annually. So I have this figure 0.03 divided by 2. That's what am I having? Now we're having 6 is equal to 5 0.4 multiplied by what?
1.084.
1.084.
84.
What is the exchange rate?
5.85.
5.85. Okay, so $1, 6 or 8?
85.
85.
Yeah.
Okay.
1.5. Yeah, 1.85.
Is it 1.85 or 5 point?
5.85.
Okay.
5.85.
Okay. So this will be the exchange rates at the end of the 3 months and also at the end of the 6 months. So they can ask you where the company should go for the rate that the bank is offering them in 3 months time, and it was the 6 month time. But this one, the question is not asking for anything like that. How do we hedge our currency risk? How do we hedge our currency risks? So hedging techniques. Okay. So how do we manage the the hedging over here is just what? How do we manage the movement in our exchange rate so that it will not go against us in the future? Okay. So we have the internal. So we can do this internally. The company can do this internally. Internal hedging techniques. So we have the internal techniques and we also have the external techniques. The internal is the company is going to be uh, deploying these techniques themselves. But the external they are going to be involving a party or a third party to do those things. So if you come to the internal, okay, the common one that you are going to be doing, you see, most of the time you are going to be buying things that is in USD. Do you see the currency? Do you see the price of the items in Ghana cedis or USD? If you are buying from a US company, do you see the price of the items that you are buying in in Ghana cedis or you see it in USD? Okay, so we have invoicing in home currency. Invoicing in home currency. So if we are now selling to somebody that is in US, we will just price our items in Ghana cedis. So if they want to pay, they have to change the dollar to Ghana cedis now and pay. So that is what most of the US companies they do. They will invoice the items to you. They will sell to you in their home currency. So you have to, if you want to pay, you have to change the Ghana cedis now to dollar. In this particular case, the risk is always shifted to the customer. So risk shifted to the customer. This can actually impact yourselves because the customers will feel like you don't care about them. So it means that they are bearing the risks. So the company will invoice in their home currency. If it's a Nigeria company, they will price their items in Nigeria in the Naira. So if you are in Ghana, you buy and if you want to pay now, you pay them in Naira. So it means that you use Ghana cedis. You not change the Ghana cedis to pay them in Naira. If there's any exchange rate movement, you, the customer, is going to suffer that particular one. So there was the invoicing in home currency. So the NGB can decide to invoice or sell to you in their what?
Hello,
In their
Senior.
local currency. Yes, please.
Please, I'm sorry for taking you back. I thought for
I'm not
the
going, I'm not going back. Okay, so
oh
the sorry for taking you back. That one I'm not going back. So
no,
if
it's about the questions we are solving. The IC and the IB. I thought um correct me if I'm wrong. I thought the IC is for the counter currency and the IB is for the base currency.
and
The
what is
the
the counter currency?
that is the foreign.
No, the counter currency cannot be the foreign. The counter currency is the currency in the currency of the what? Of the base, the currency of the what? Of the or the local currency. Let me just say the local currency. That is the counter currency or the other what? Currency. The
Oh,
B is the base currency. The country in which the currency is always, or the country whose currency is always in the one, 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 one. That is what we call the base currency. Okay, so the
okay,
currency that
okay,
you are putting in the one, one, that is the base currency. The counter
okay.
currency is the other currency, which should always be the base which is always the home currency, the Ghana cedi, the local currency.
Oh,
Okay.
okay. Thank you very much.
So invoicing home currency. So we invoice our this now in home currency. We also call something matching receipts against what? Matching receipts against matching receipts. Matching receipts against what? Against payments. Okay, let's come here. Matching receipts. Matching receipts against what? Matching receipts against payments. Okay. Matching receipts against payment. Please, this particular matching is what? Is only possible if the receipts and then the payments are due in the same way, are going to be due in the same period. Okay, I will explain that one to you now. So let's come here. So let's say in 2 months' time, in 2 months' time, in 2 months' time, we are going to receive, okay, receipts will be due to us from receipts. So in 2 months' time, we are going to be receiving USD of 25,000 from a particular customer. In the same 2 months' time, we are going to be making payment of 30,000 to a supplier in what? In US. Please, what if you want to go about this? Will you first receive 25,000 from the customer, change it to Ghana cedis, and go back there and change it to dollar and pay, or what are you going to be doing? You are receiving 25,000 in 2 months' time. And in that particular 2 months' time too, you are going to be paying 30,000. Okay, how do you go about this transaction? Will you receive the 25,000, change it to Ghana cedis, then you now go back to the bank and change it to what? To USD again, or how do you go about it?
You let the receipt and the payment, and you
Um,
wait to receive the balance.
Okay, so how much are you going to be paying this particular transaction? How much are you going to be incurring? How much are you going to be changing? Okay, how much of dollar are you going to be changing to be able to settle this transaction?
5,000.
You'll be changing 5,000. What it means is that the 25,000 that you're going to receive from the person is already in dollars, so you don't change it. You just go and change, you just go and use Ghana cedis now to change what? To change, you use Ghana cedis now to have what? To buy the 5,000 USD, which you are going to be using to what? To add to the 25,000. So you not go to the bank and say, or wherever that you are going and say, oh, you want to change 25,000 USD to Ghana cedis. Then you go there and change that particular amount to USD again. You are going to be losing because the rate at which those people are going to be selling is different from the rate at which they are going to be buying, because they're in there to make business. So if you change $25,000 to Ghana cedis and use the same amount to take dollar now, the amount that you're going to be getting will be different, will be lower than the amount that you first change to have the Ghana cedi, because the rate is going to be different. The rate at which they are going to be buying is going to be different from the rate at which they are going to be selling. So mostly they will give you offer or ask rate. Okay, we'll be taking a question. I will tell you what we mean by ask rate and offer rate. So what you do over here is that you just tell whoever is selling for you, okay, we are going to receive 25,000. Put that 25,000 so that we can add 5,000 to it and pay the 30,000. This is only, the matching is only possible when you are going to be receiving and also making the payments in the same period. They are all due in the same period. Okay, this net amount now, you can decide to use forward rates, which is an external, and you can also decide to use money market rate. So we'll be looking at this one, possibly let's see, tomorrow or something. So we can use the forward rates or the market rates. I'll be explaining that one. Maybe we do the theory part now and we do the calculation. So mostly it will be about the body rates, this one, and sometimes options. Okay, the calculation will be about this one, uh, and sometimes options. So let's come to the next one. The next one is what we call leading and lagging. Leading and what? Lagging. Leading and lagging. So we have what we call leading, and lagging. Okay. The leading and lagging is where you have information about the what? You have information. Okay, leading and lagging is where you have information about the exchange rate movements in the future. So what we do is that if you have information that the exchange rate will be okay, that today's exchange rate. So let's say that today's exchange rate is 12 today is equal to 1 USD. Okay, you are thinking about buying that thing in a month's time. You have not realized that oh, this particular this in a month's time, the exchange rate will now be 14 today. Okay, what we can do is that you can make a deposit to the person that you pay. You can make a deposit so that you can take movements. You can take what the favorable movements in the exchange rate. So you can make a deposit. What it means is that you are leading. Okay, you are trying to take an action in favor of the exchange rate movement in advance. Okay, or the person can now sell to you. The person can sell to you, or you can sell to somebody, or the person can sell to you. Anyone, whoever is using it, the person can sell to you at the date of the transaction. The person is saying that what 12 cities equal to this one. When the person has given you 12 months, the person has given you 12 months is 2 months. The person has given you 2 months to settle. Okay, you know that in 2 months' time, the exchange rate will now be, let's say, 15 cedi is equal to USD. So since they are giving you 2 months to pay, so you know that okay, after 5 days of the transaction or after 1 month of the transaction, the exchange rate now is what is $1 is equal to 13 cedi. Okay, so if I'm waiting to pay at the end of the 2 months, I'll be paying 3 cedis in excess. Okay, so what I'll do is that okay, I've estimated the exchange rate to be 15 cedis at the end of the 2 months, which I'm going to be paying. If I want to wait till 2 months to pay, I'll be paying 15 cedis for $1. But now, after 1 month, the exchange rate is now what? $1 for what? For 13 cedis. So it means that what I'll do is that I'll pay quickly to take advantage of what? To take advantage of the exchange rate movements. So what am I doing? I'm leading my transaction. Leading means that you are trying to pay earlier. Okay, you are trying to settle your debt earlier to take advantage of what? Favorable movements in the exchange rates. So they have sold the thing to you, they have given you 2 months. You have estimated at the end of the 2 months, the exchange rate will be 15 cedis to $1. Now, after 1 month, you have now realized that the exchange rate is going to be 13 cedis is to $1. So you will say, I'll settle. They are giving you 2 months, so you can pay before 2 months. So you will settle after 1 month. Then I'm going to be saving exchange rate uh movement of 2 cedis per dollar. So if you are doing this to take advantage, you are trying to settle or you are trying to collect your receivables to take advantage of favorable exchange rate movement before the actual settlement date or before the actual transaction. They say that you are leading what? You are leading the transaction. So you are leading. You are trying to do things quickly before the actual day to take advantage of what? To take advantage of exchange rate movements. Then we now come to what we call the lagging. The lagging means that you are trying to delay payment to take advantage of what? The exchange rate movements in the future. So the time that you are today, you are going to be buying that thing in what? In a month's time. But today's exchange rate is, let's say, 12 cedi is equal to $1. Okay. But you know that in a month's time, the exchange rate will now be 10 cedi is equal to $1. So what I will do is that I have to wait for the 1 month time and buy. Why am I doing this? I'm now delaying. I'm delaying now to take advantage of the exchange rate movement. That's what we call lagging. Okay. If they have sold a thing to you for for 2 months on credit for 2 months, you are going to take 2 months to pay. So what will happen is this figure. So at the date of the transaction, let's say the exchange rate was 12 cedi is equal to 1 USD. Okay, you have estimated that at the end of 1 month, your exchange rate will now be USD 1. But at the end of the 2 months, which is the time that you are going to be paying, okay, the exchange rate will now be 11 cedi is equal to this particular one. So what you'll be doing is that you will not pay early. You'll be delaying So you pay at the end of the what? The second month. Why are you doing that? You are delaying the payment to be able to take advantage of what? The exchange rate movements before the deadline. If you are doing that particular one, we are saying that you are lagging. Okay, leading and lagging. So it's either you act fast to take advantage or you delay to take advantage. So if you are acting fast to take advantage, you say you are leading. If you are delaying to take advantage, you are lagging. That's what we call leading and lagging. We also have another one that we call the netting method. The netting method. So the netting method is very simple, and this always works among what group accounts. We use the netting for mostly group accounts, but just unfortunately I don't have any question. Okay, but mostly this one they have been asking this one when there was advanced financial management, but there's no advanced financial management again. So we have netting method. Okay, the netting method works in the group account. So the netting is somehow different from the receipt and payment. The receipt and payment, individual can then net this one. But this one normally works in group accounts. So let's say we have a group. The group is located in France. Okay, the group company is in France. Okay, so we have some subsidiaries in Cote d'Ivoire. We have some subsidiaries in the Ivory Coast. So let me see Ivory Coast. We have subsidiary in Ivory Coast. We have subsidiary in Ghana here. We have subsidiary in Nigeria, and we have subsidiary in, let's say, Cameroon. So we have some subsidiaries in Cameroon. Okay, we have subsidiaries in Cameroon. Okay, let's come here. So we know that Cameroon and Ivory Coast are going to be using the CFP. Okay, Ghana is going to be using cedis, and Nigeria is going to be using what? The Naira. So there can be a situation where Ivory Coast can be owing what? Ivory Coast can be owing the subsidiary in Ghana, and Ghana can be owing Nigeria. Okay, and uh, Ivory Coast will be owing Ghana, Ghana will be owing Nigeria. Okay, then Cameroon, Cameroon can be uh, Cameroon can be let me put it again. So Ivory Coast is now owing these people, and Ghana is owing Nigeria. Okay, the same way, Ghana is owing Cameroon. Okay, Ghana is owing Cameroon. Ghana is owing Cameroon. And let me do a proper combination here. Ghana is owing Cameroon. Ghana is owing what? Cameroon. And Ivory Coast is owing, Cameroon is owing what? Cameroon is owing Ivory Coast. So let's come here. We can do some matching over here before the payment will be done because we want to avoid this one. Okay. Ivory Coast and Cameroon are using CFP. So Ivory Coast is owing Ghana now. We have to now change the Ivory Coast. We now have to change the CFP. Okay. The CFP now to Ghana supposed to pay. The same way Ghana is owing what? Cameroon. And Cameroon is owing Ivory Coast. So this is what will happen. Ivory Coast will pay to Ghana. Ghana will use that money to pay Cameroon. And Cameroon will use that money to pay Ivory Coast. So that is going to be a long process. So what is going to happen now is that, okay, since Ivory Coast is now owing Ghana, the same way Ghana is owing Cameroon and Cameroon is owing Ivory Coast. Okay, let's come here. The amount that Ghana is owing Ivory Coast, how much is it? Let's say Ghana is owing Cameroon 5,000. Okay, Ghana is owing Cameroon 5,000 CFA. Okay, and Cameroon is owing these people, let's say 5,000 CFA as well. Okay, or let's say not 5,000 CFA. So that is going to be, let's say 3,000 CFA. Okay, and these people are owing these people also. So the amount that they are owing them, if you change it to what? If you change it, if you want to use the CFA equivalent to pay, this is what we do. We will now be using, let's say we'll be using 4,000 to pay these people. Okay, so Ivory Coast will be changing 4,000 CFA to pay the Ghana. So this is what we are going to be doing. This is what we are going to be doing. Let's come here. Okay, Ivory Coast will be using 4,000 to pay Ghana. Ghana will be using that 4,000 to pay Cameroon. Cameroon will be using 3,000 of that amount to pay what? To pay this one. So this is what will happen. since you are going to be using, 4,000 to pay, we will tell Cameroon to pay 3,000. We will tell Cameroon, okay, we will now tell Cameroon to net, we now take, we now ask Cameroon to net the amount, because what will happen is that Ivory Coast is going to be using 4,000 to pay Ghana. Ghana is going to be using that 4,000 to pay Cameroon subsidiary 5,000. So this is what we do. Okay, this is what we do. We will say that, okay, what will happen is that Cameroon will be saying that, okay, Ghana is owing me 5,000. So the 4,000 that you are going to be paying to Ghana, take the 3,000 that I'm owing you out of it. Okay, so they will cancel this particular one. So the debt that you are owing, since Ghana is owing you 4,000, Ghana will be using 4,000 to pay me. So take the 3,000 that I'm owing you, give the remaining amount of money to Ghana. So Ivory Coast will be giving only 1,000 to Ghana. Okay, because they have settled 3,000 of the amount that the Ghana is owing Ghana is owing the Cameroon subsidiary. What it means is that the exchange rate losses that would have been incurred over here, if Ivory Coast is changing this one to what? To Ghana cedis, there will be an exchange rate movement over there. The Ghana will now change the what? When we are paying Ghana in cedis, Ghana will not change the cedis to CFA to pay 5,000. There will be additional exchange rate losses over there. But since we have net these amounts, any losses will be cancelled because there's no losses. We are using the same amount to pay them. So since you are using 4,000, take the 3,000 that we are owing you because Ghana is owing now. Give the 1,000 to Ghana, or just give us 1,000 CFA. Ghana will now do a top up of 1,000 CFA here. So we net off everything and we just pay the remaining amounts. So give us the 4,000 that you are going to be paying Ghana because Ghana is owing us owing us 5,000. So give us the 4,000. That 4,000, take your 3,000. So you give us 1,000. Ghana will now change only cedis to 1,000 CFA and pay us instead of us paying them one by one. So we do this netting for group accounts. The netting is mostly for group accounts. The subsidiaries will now net off their intra-group balances between companies, and that is what we have done over here. So this person will be owing this person, this person will be owing this person, but it's likely that some people are going to be using the same currency to settle themselves. So we net it, then we now only deal with the net balance. We only exchange the net balance, and Ghana is going to be changing only 1,000 over here to settle instead of Ivory Coast changing to give Ghana cedis. Ghana will now change the cedis to CFA and pay them. The CFA that Ivory Coast is paying Ghana, just give it to Cameroon. Okay. Then you take the amount that Cameroon is owing you. So you give them 1,000. Ghana will now look for the 1,000, will now change the Ghana cedi up to the amount of 1,000 CFA and now pay the Cameroon company. So this netting. Netting is purposely for what? For group accounts. Okay. Let me talk about the external hedging techniques before we close. Okay. If I don't talk about anything, I should be able to talk about the forward contracts. Okay. So techniques. So external hedging techniques. External hedging techniques. Okay. External hedging techniques. The first one is the forward contract. The forward contract is where the forward contract arrangement is a situation where, okay, you are going to be paying or you are going to be receiving a certain amount of money. In 2 months' time, you can go to a bank right now and lock up the exchange rate. You can go to a bank right now, have an agreement with them that, okay, I'm going to be receiving USD of 200,000 from a customer in US in 3 months' time. So today's exchange rate is this one. So I don't know what will be the exchange rate. So what will happen is that give me an exchange rate. So if today's exchange rate is $1, is equal to what? Is equal to 12 cedi. It can happen that the exchange rate might come down. If the exchange rate is coming down, we are going to be suffering because we are going to be changing the USD to what? To Ghana cedis now. So we don't know what will happen in 3 months' time. So we are now having an agreement with you, a forward agreement with you. We have the agreement now that is going to be having effects in the future. So we have an agreement now. Give us a rate so that if we bring the 200,000, you'll be able to sell it or you're able to buy it at that particular rate. So we agreed on a rate now that is going to be used in the future for a fixed amount, for a fixed date, and for a fixed rate. So instead of us being there to be waiting for things to improve in 3 months time, things can actually go against us. So let's just go to a bank and lock up a rate for that 3 months. So we have an agreement with them. So I'm bringing this amount of money. How much are you going to be buying it? How much are you going to be selling it to me? This is the rate. So we agreed on that rate. I'll bring the money that time. Then you actually what? Sell it at that particular rate. And the question, if they want to give you forward rate, the question will always give you the forward rate maybe in 3 months time or something. Or they can give you how you calculate the forward rates, how you calculate the forward rates. So sometimes they can give you a quotation on the forward rates. They can tell you that the USD to Ghana cedi, they will give you something like, let's say, 12 cedi to 15 cedi. So the 12 cedi to 15 cedi, we call something ask rate and the offer rate. Okay, the offer rate is the rate or the bid rate. Okay, the offer or the bid rate, the offer or the bid rate is the rate at which the bank, if it is currency or something, is the rate at which the bank will be what? The bank will be buying the currency. Okay, if it is Ghana cedis, the offer or the bid rate is the rate at which the bank will be what? Will be buying the rate at which the bank will be buying this one. Let me check that for you again. So okay. So the offer rate is the rate. If it is Ghana cedis, the offer rate is the rate or the bid rate is the rate at which the bank will be buying the currency from you because this we are going to be multiplying. So the bank will buy at the what? At the lower rate. So if you are bringing Ghana cedis, they will buy at the lower rate and they are going to be selling at the highest rate. So this is the offer rate, the rate at which the bank will be buying. Then you come to the ask rate. The ask rate is the rate that the bank will be selling. So the bank will always sell at the highest rate if you are multiplying. So if you are now changing dollars to Ghana cedis, the bank will always sell to you at the highest rate because they are there to make profits and they will buy from you at the lowest rate. The situation where you have to divide to get the other currency, the bank will sell to you at the highest rate and the bank will buy at the lower rate. So this one, they can give you this one. This is the rate, this is the lower rate. This can be the rate that the bank is buying. If it is Ghana cedi to USD, it means that we are multiplying. So this would be the rate at which the bank will buy. And this is the rate at which the bank will sell. Okay, so they can give you lower, they can code the rate from 12 to 15. What it means is that bank will buy the dollar at 12 cedis and the bank will sell the dollar at 15 cedis because they are there to make what? Profits. Okay. Another way of giving this particular quotation is this one. So they can give you the rate like this. This is the rate at which the bank will buy if we are multiplying to get the equivalent. But if we are dividing, the bank will now buy at the lower, at the higher rate because if you divide, the bank will be paying lower and the bank will be getting higher. So if you are dividing with 12, the resultant will be higher than if you are dividing by 15. So the bank will pay less for it. The bank will sell at a higher rate. Okay. So this is the issue. If you come here, they can also do this like this. Okay, they can also do something like this. And they'll give you something like, okay, they'll give you something like, let's see, 0 points. Okay, let me just not use 0 point because we're using Ghana cedis. So they can give you 12 plus or minus 12 plus or minus 12 plus or minus 1. Or let me just say 12 plus or minus 12 plus or minus 0.05. Okay, so they can give you this rate. This rate, they are quoting the rate for you in what? They are quoting the rate for you using the least and then the higher. Okay, the minimum rate and then the maximum rate. So they are saying that plus or minus. What it means is that for you to get the lower rate, subtract 0.05 from 12. So this will be 12 minus 0.05. That will get the lowest rate. If you want to get the highest rate, add 12, add 0.05 to 12. So you'll be having 11.95 against 12.05. So this will be the rate at which the bank is going to be buying and the rate at which the bank is going to be what is going to be selling. So they can do something like this. For you to get the lowest rate, just subtract plus or minus. So subtract this. If you want to get the highest rate, increase this. The rate can also be set as premium. Okay, they can say that the spot rate, the question can tell the spot rate is this figure. The spot rate is this figure. And they will say that the rate will be quoted at a premium of 10% in 3 months' time. What it means is that the bank is going to be increasing this rate. The rates are going to be increasing by 10%. So you come here, the new rate will now be 13.2, and this will now be 16.5. So a premium means that the rate will be increasing. Or they can say the rate will be done at a discount. Discount means that we are going to be reducing. So we reduce this by 10% and also reduce this by 10%. So the rate can be done at a discount or as what? At a premium. Or they can quote this one for you like this. You just have to find your lowest rate and you're also the highest rate. I'm saying that forward contract is an agreement, between two institutions, mostly the bank, where or another entity, where they agreed on a fixed date for the fixed amount and at a fixed rate. So we agreed on the amount that I'll be bringing. We agreed on the rate at which you are going to be buying or selling the what, and we also agreed on the date that I'll be bringing the money. Forward contract is always what, over the counter contract. It's something that cannot be sold on the stock exchange market. It's something that is going to be over the counter. It cannot be sold. It cannot be what, transacted in the organized market. It means that you cannot sell it to somebody and later come and buy it. No, it will just be between you and the bank. That is over the counter. It's an arrangement that is somewhere. Okay, that's an arrangement that is somewhere. It's over the counter. You cannot actually what, convert that into cash in the organized market like stock exchange market. But if you come to currency futures, which they will always ask you the difference between the two. Futures is what? It's an organized contract which can actually be what? Actually be traded on the stock exchange market. So you can go there and go and buy instruments. So you can go there because uh you want to actually control the exchange rate movement at the date of the transaction or at the date of the payment. You can go there and buy options, or you can go there and buy futures. You can go to the stock exchange market and buy instruments in the form of futures. So you can buy it and sell. So you can buy it and sell, hoping that the price will increase again. Then you buy at a lower rate, or you buy hoping that the price will increase, then you sell. So if you buy at 10 cedis now, the price has increased to 12, and you are selling now, it means that you are going to be getting a profit of 2 cedis. So if there's any exchange rate movement at the time that you are going, this profit that you are going to be getting a transaction can actually be used to net the loss, some part of the loss. So that is also that particular one, but I'll be talking about the futures maybe tomorrow. We have five under this one. We have the money market, where we now use money markets. We now trade in the short-term market. So we use money market to now hedge or manage the foreign exchange. We also use currency options, where the bank will be giving us options that, okay, we have the option to, so they will give us a rate that, okay, this will be the rate that we are going to be transacting, but they are giving us options that whenever the rate is now reducing, we have the option to exercise at a particular rate. That options will always come at a premium, because if the bank has given you a rate of 15 cedis to $1, but they are now saying that if the rate has increased, you have the option to exercise at what, 14 cedis to $1. So if the actual rate is now 16 cedis, the bank will be losing 2 cedis or something. So you have to pay the bank now for the loss, because they are also in the business for a profit. So you pay them a premium. You also have the currency swap, where you swap the currency. I can take loan in Ghana cedis. Okay, but I'm a foreign organization. You can be a local organization. You take loan in USD. So for me, I'm what? I'm a foreign company in Ghana. My operations are in US. So if I want to service my loan, it means that I have to change the USD to Ghana cedis now. If you also want to service your loan, you have to change the Ghana cedis to what? To USD. What I'll do is that I'll give you my Ghana cedi loan to service for me. You also give me what? The dollar loan to service for me. So what will happen is that we will not be doing any exchange rates over there to suffer anything. So what will happen is that I'll pay your loan for you in Ghana cedis. You pay my loan for me in a dollar. What will happen is that we now come back. What is the excess amount that you have paid? I will now refund the excess amount to you, which we call the currency swap. So we'll be looking at that one. For now, we are done with, or we are going to be stopping on the forward contracts. Tomorrow we continue with that one and pick some tutorial questions on the forward contracts, the money market, and maybe options, or we look at the interest rates also. If there's any issue, if there are no issue, then we have to go back to, okay, those who want to sleep can go back to sleep. Those who want to go to work, you can go to work. And those who want to room, they can room. And those who want to go for lectures, you can go for lectures. So for me, I'm picking the sleeping part. And I'm going back to sleep. Okay. So I'll see you guys tomorrow. But all things being equal, you might receive your assignment on working capital management and the business valuation today, which will be submitted within next week. Okay. If there are no issues, so that I'll see you guys tomorrow, and enjoy the remaining of your days or whatever. Okay. So let's see what will be. Okay. So let me find the way and how it does. Okay. Thank you for coming. Smith. I'll see you guys tomorrow.